Do you want to withdraw funds from your RRSP tax-free? Well, then stay tuned to the end of the video to learn how. For many retirees, the RRSP is a cornerstone of their financial plan. It provides for valuable tax deductions while working, all the while allowing those investments to grow tax-deferred. However, when the time comes to withdraw, those tax savings can quickly turn into a tax burden. One popular strategy to minimize taxes is the RRSP meltdown. The RRSP meltdown is simple in theory. Withdraw funds while you're in a low tax bracket to avoid leaving a large balance that would be taxed at the highest rates upon death. For example, let's say you have $1 million in your RRSP and you die. That entire amount would be added to your final tax return, assuming you don't have a spouse. This is likely going to push you into a 50% tax bracket, leaving your heirs with a significantly reduced inheritance. But for retirees that are already in a high tax bracket, this strategy doesn't necessarily make sense. Any withdrawals will just push your income up even further, resulting in immediate and substantial taxes. So what's the alternative? The answer lies in creativity. Let's explore a lesser-known strategy that can help high-income retirees reduce taxes on their RRSP withdrawals, potentially even making them feel tax-free. Now, before we get into it, let me just be clear that this strategy isn't for everyone. There's a time and a place where this strategy will be effective, but there's also a time where the risks of this strategy aren't worth it. All right, so let's meet Ben. He's 67 years old and retired, and he's making about $200,000 per year between his pensions and different investments. He also has $2 million in his RRSP, so he's looking for ways to draw out those funds in a tax-efficient manner. Here are Ben's challenges. His income puts him in the 46.72% tax bracket in Manitoba, and any withdrawals from his RRSP will just push him up higher, leaving him with a bigger tax burden. At first glance, withdrawing funds from his RRSPs seems like a losing proposition, but with some strategic planning, Ben can minimize his taxes. Ben owns a $1 million home, and he has a home equity line of credit set up on it for $500,000. Now, Ben can access this money at any time that he wants for any reason that he chooses. Now, in this instance, he would borrow the $500,000 and invest in a non-registered account. Now, for this strategy to work, it has to be a non-registered account. He couldn't use those funds to invest in a TFSA, and we'll get to why in a second. The line of credit has an interest rate of 5.95%. So if Ben decides to only pay the interest on the line of credit, he will have paid $29,750 throughout the year. Again, this is assuming that the interest rate doesn't change. Because Ben is borrowing to invest, he's going to be able to deduct the interest on his tax return. So again, assuming his income is $200,000, after the interest deduction, his income now stands at $170,250. Now, there are rules for the interest on a line of credit to be deductible. He has to invest the proceeds in a non-registered account. He wouldn't be able to use a TFSA in this instance. He also has to invest the funds in something that is reasonably expected to provide an income in the form of interest or dividends. He couldn't invest in something that only provides for capital gains because that will not allow for tax deductibility. So let's say that Ben invests the $500,000 in XYZ fund. And let's also say that XYZ pays him about $10,000 for the year. So now his income goes from just over $170,000 to just over $180,000. Let's also say that the investment grows from $500,000 to $550,000, leaving him with a $50,000 gain. Now in this instance, he hasn't sold XYZ fund, so he doesn't have to report the $50,000 gain on his tax return. Ben's income is sitting at $180,250, so he's able to withdraw $19,750 from his RRSP to bring his income back up to $200,000. So he's in the same position that he was before, except he's been able to draw out almost $20,000 from his RRSPs tax-free. This approach leverages the tax rules around deductible interest. By offsetting taxable RRSP withdrawals with the corresponding deduction, retirees like Ben can minimize the tax impact of accessing their funds. While taxes are still technically paid on the RRSP withdrawal, the offsetting deduction creates a net zero effect, making the process feel like it's tax-free. While this strategy is innovative, it's not without its risks. Let's explore what you should be considering before implementing this strategy. For one, you're borrowing money. Is this something that you actually have to do to reach your financial goals? Probably not. You're retired. It's time to enjoy life rather than adding more financial complexity. Another consideration is the interest cost. At 5.95%, the cost of borrowing is substantial. For this strategy to be effective, the growth on the non-registered account has to be more than the cost of the debt on the home equity line of credit. The third problem with this strategy is that you're limited in your investment choices. So as mentioned, you have to invest in something that is expected to provide you with income in the forms of interest or dividends. So you can't just put it all in investments that are just focused on capital gains, which are going to be more tax efficient in the long run. Your cash flow will also be impacted by implementing this strategy. So in this scenario, Ben is paying almost $30,000 a year in interest on the line of credit. Now this money has to come from somewhere, so you just need to make sure that you have the budget to handle this strategy. This approach isn't a one-size-fits-all solution. It's most effective for retirees who have high income, significant RSP balances, and substantial home equity. Accessing RSP funds without creating a massive tax bill is a challenge many retirees face. Now with creative strategies such as this one, you can keep more of your hard-earned savings. To learn how this strategy or others could work for you, check us out at transcanadawealthmanagement.com.